Welcome to the weekly update, where I'll go over the action in the market for June 20th through the 23rd, and then we'll see how things look for the week of June 26th through the 30th. We had a down week. In some ways, not really surprising. The market had gone up pretty far, pretty fast. A lot of our indicators on the daily charts were getting extreme positive. A lot of people were getting a little overly optimistic about things. And when that happens, typically we see some kind of a pullback. Now, what we're trying to decide on the daily charts is, are we just pulling back in a normal retreat, or are we going to switch over and go more negative? On the weekly charts, we're seeing a little bit of a pullback as well, but our charts are still suggesting that things are quite positive overall. Before I get started in this week's video, please note that there is a PDF of all the slides and charts that you can download. It's in the description below the video. Also, I have a private Facebook group that you're more than welcome to join. There will be a new poll that is posted after I get done doing this video, and I'm trying to really be more vigilant about YouTube comments. I really have a personal pet peeve against these bot comments, and I go through and I wipe them out really quickly. I just want to keep that a friendly spot where if you want to disagree with me, that's fine. Especially if you have an area that you don't quite understand or that you've come to a different conclusion. I have no problem with that. Also, sometimes people just make statements on there that I really just can't answer, so I just don't really do anything about that. But I'm just trying to make it so that if you want to post a comment, you're more than welcome to do that, but I don't want garbage on there either. That's another reason why at the end of each video, I give you my email address. If you want to have some kind of a more private conversation with me, we can do that. You want to take it to the next level? We'll meet on Zoom or Skype or something so that we can talk about certain things. But I just want to avoid all the garbage that can sometimes come into the comment section. Also, please note that I do post these same videos on Rumble, or you could say I post on Rumble and YouTube is my backup, however you want to view that. Here is the channel. If you can't ever find me on YouTube, feel free to look for me on Rumble. Let's go back and talk about the week session. For the week, the S&P was down 1.39%. And volume was above average. Now, a lot of that was based on Friday. The Russell indexes right at the end of the day did a rebalancing, and that produced a tremendous amount of volume. The rest of the week, we were pretty much below average most of the time. That could be seen as positive because when we were going up, we saw an increase in volume. Now that we're pulling back, at least initially, we are seeing that on below average volume. The technicals are still positive on the weekly charts overall, and I'll go through and point out where there are variations on the daily charts. It's still about inflation and interest rates. Another scenario that was developing later on in the week, we have all these central banks around the world that are raising rates. They're having to battle inflation, and now that's producing some growth concerns because this is what central banks do. They keep raising rates until they break something, and that affects the overall economy in that country, including the United States is in that same scenario. This can grow into being more on a global basis. Our trend is still strengthening overall. Now we're seeing the green line coming down, but it is on top, and the ADX is above its moving average. Looking at the different indexes, the Dow was down 1.7%, the NASDAQ down 1.4%, as was the S&P, and the small caps, as denoted by the Russell 2000, they were down 2.9%. Let's go over some of the major things that happened. For the week, the S&P broke a 5-week winning streak. The NASDAQ broke an 8-week winning streak. There was a growing sense that started to develop about a week ago that the market was really due for a pullback. So far, the losses that we've seen were driven mainly by profit taking. There's also growing concerns, as I mentioned, about global growth and the lag effect that the rate hikes that all these central banks are raising, that can have a real impact economically. Fed Chair Powell came out. He gave his semi-annual monetary policy testimony first before the House. He pretty much said what we already know, that there could be 2 more rate hikes before the end of the year if the economy performs as expected. And that's kind of open-ended right there. That's when we'll be watching the economic reports. Fed Governor Michelle Bowman, who is a voter, said additional policy rate increases will be necessary to bring down inflation. We know that already. Then on Thursday, when Chair Powell was meeting, there was a bit of argument going back and forth among committee members regarding capital requirements for banks, as a lot of us are anticipating there might be more to this story that we haven't really seen yet. When that started going back and forth, that really led to some weakness in the banking sector. Several central banks did announce rate increases this past week. The Bank of England went up more than they expected, up 50 basis points. Now they're at 5%. Norges Bank increased it by 50 basis points to 3.75. Swiss National Bank up 25 basis points to 1.75. And they have a real inflation problem in Turkey. They went up 650 basis points. Their rate is at 15%. Also, later in the week, a lot of preliminary manufacturing PMIs came out and they were weaker than expected. We saw this in Japan, Germany, the UK, the Eurozone, and the US was also in this mix. They all came in below 50. That shows contraction in manufacturing. Some of the economic data that came out in the US was weaker than expected, but jobless claims remain elevated. They were unchanged, but they're still pretty high overall. Housing starts was a surprise. They came in really strong, which helped the home builders outperform for the week. Trading volume was extremely heavy on Friday due to the rebalancing in the Russell indexes. Taking each day, we were closed on Monday. Then on Tuesday, the market seemed due for a pullback, but it closed off of the lows on that day. Then on Wednesday, there was an early decline, but an afternoon rebound. Thursday saw the mega cap stocks doing pretty well, which helped the S&P 500. And then on Friday, we saw the weakness follow through to end the week. Let's go back and look at our poll results. One question is kind of funny here. The S&P 500 was able to close above 4,400 a week ago. Did you find this surprising but welcomed? 30%. Surprising but not welcome because you were short? 40%. Not a surprise since it was expected, 30%. So pretty much across the board there. After the FOMC meeting on June 14th, the decision was to leave rates unchanged, but stated that rates will likely be raised in the future. At the next meeting, do you think the FOMC will? And 86% say they will raise rates. Then, this is kind of the funny one. I'm considering doing another supplemental video. Actually, I've changed that a little bit. I'm thinking of doing a monthly video that just deals with the economy. And the idea behind this came, what is the evidence for or against that we will go into a recession? If the video is posted, one person actually said they won't watch it. Well, cool, at least you're honest. For some reason, I just found that hilarious. I just kind of put that up there just to see if anybody would answer it that way. And then the last one is the S&P 500 has broken above resistance and the charts are looking stronger. This was at the time I posted this poll. However, in the coming week, do you think the S&P will continue to move higher, 13%, pause before going higher, 13%, reverse to a pullback before then we'll go higher after that, or reverse and begin a new downtrend? Half of you thought that's what would happen. We don't really know at this point. It was hoping that we would get some things decided, but the jury's still out on where do we go from here. Looking at some Isabel Net charts from their blog, we're seeing the insiders' transactions really start to go up. When this red line really moves up, we get more into a bearish stance. So that could have some headwinds for the market. Then we look at the mega cap tech and compare it to the rest of the S&P on a PE ratio basis. The big mega cap stocks are having a PE ratio of 30 right now, where the rest of the S&P is at 17. That's more fairly valued. And then in the past week, we saw the largest outflow from tech. When we look back over 10 weeks, people were starting to take some profits. Then VIX seasonality. This is one thing that a lot of people are complaining about, and I've been watching this for quite a while. We're seeing the VIX just go low, low, low. Remember the adage, when the VIX is low, it's time to go. People keep expecting it to really break out. On a seasonality basis, in July, we see the VIX really starting to pick up until about October, and then going into the latter part of the year, it starts to come down again. Now, this is just what has happened seasonally. We can always break the rules when it comes to what has happened in the past. Sometimes this can be a useful guide to look at. Then earnings estimate, and I put the red arrow on here. No matter what's happening, the earnings estimates continue to go up. Whether it's Morgan Stanley or the consensus, they continue to go up as we're looking further out into the future, and that's giving a lot of justification for stock prices to go up. Then we look at the equity allocation. It's at 61% right now, where it has been turning back up as we saw some recent strength. There's two ways to look at this, and you have to mind the comma in this first sentence. U.S. consumer savings rate only 4.1%, comma, below 9% long-term average. If you take that comma out of there, you get a completely different meaning out of that sentence, meaning it's only 4.1% below 9%. Well, this just shows that according to this chart, we are really dropping in our personal savings rate. People are having a really difficult time right now. We have inflation to worry about for the first time in about 40 years. And now people are finding that they're having to dip into their savings. And to a degree, they're even having to start using their credit cards just to make ends meet. Then we look at the large cap stocks. This is the 10-year annualized rolling returns, where we're still looking at being up at about 12.6%. Then the last chart, this can be a little harder to understand. The 52-week market breadth is as narrow as any time since the tech bubble. That was the dot-com boom and bust that we saw back in the late 90s into 2000. This is where things were going right now. We're starting to really drop. That's the dark blue line. There are some parallels that are starting to develop as we get into this AI world, that maybe some things are looking similar to how they were looking in 1999 and 2000. I'm not really willing to take that stance yet. It still seems like things are under control. Plus, we had another mania develop over the last 5 to 10 years, which is in cryptocurrencies. That seems to be recuperating a little bit right now, but a lot of people got wiped out through that whole thing. Looking at FactSet, and I really kind of deviate away from this headline. Where are analysts most optimistic on ratings when we're looking into the third quarter? I just bring up this chart to show where after the beginning of 2023, we're starting to see analyst estimates going back up overall. And as I keep saying, that's justifying stock prices going higher because stock prices are ultimately driven by earnings. Then we look at our charts. Here's going back to Tuesday, which was the first trading day of the week, where we did gap lower on Tuesday, and we were able to bounce back up a little bit, even though we did gap lower and we're down on the day. We also saw another gap down on Wednesday. We tried to bounce back up and then saw some weakness going into the close. We gapped lower again on Thursday, but then we were able to claw our way back and actually close at the high. Then on Friday, gapped lower, tried to make a bit of a rebound, but then saw some late day weakness going into the close. For the week, here are the indexes. All of the indexes ended up being down, but the S&P was down the least, followed by the Dow, the NYSE, then the NASDAQ 100 and the NASDAQ. And mid-caps and small-caps saw a lot more weakness. When we go back to the beginning of the year, the NASDAQ 100, the NASDAQ, and the S&P are performing the best, but all indexes remain above water. Then going back to the all-time high, all indexes are below water, with the Dow, NASDAQ, and S&P faring about the best. The Russell is really starting to show most of the weakness, and then right above that is the NASDAQ. Looking at our different sectors, healthcare was the only sector that ended up being up for the week. Now, this is from Friday to Friday, but since there was no Monday, it's really just including 5 trading days instead of 6. Real estate was down, energy, utilities, tech, everything was down. Then we're looking at our relative rotation graph. This is the usual one that I show. We go back 1 year. We use the SPY as a benchmark. And then again, as I always say, look back to your geometry class where you have an x-axis and a y-axis. The upper right is a plus plus. The lower right is a plus minus. The upper left is a minus plus. And the lower left is a minus minus. So the more we head to the right and to the top, the more positive it is. Well, we're seeing XLC, which is communication, really starting to show some weakness, where XLK is tech. That's still hanging in there pretty well. And then XLY, which is discretionary. And so far, these are the 3 areas that have been performing the best. Now, over the week, we saw some weakness. So some of the improvements that had been coming in are starting to show some weakness overall. XLF, which is financial, and I did a post on this earlier in the week where we're seeing a lot of insider buying in the financial sector. That could be longer term positive. If the financials could get beyond this banking mess and start to really show some strength, that could help the overall market. Then we look at the S&P 500 and compare it to what has happened over the last 3 months. Not a lot of change, really. We're still seeing discretionary, communication showing a little bit of weakness, as well as tech. Then the other areas that had been weak continue to be weak, but we're seeing a little bit of improvement with the financials. Then going back for the week, looking at the sectors, again, this is the last 5 trading days. Only healthcare and staples were positive. All of the other sectors ended up being negative. Going back to the beginning of the year, we have tech, communication, and discretionary, which have been performing the best. Then going back to the all-time high, energy, which keeps dripping off a lot of its returns, it's still in first place where all of the other sectors continue to be down. Looking at sentiment, we had been up in this extreme greed territory. I call it extreme positive. Now with the weakness that we saw, we're starting to drop back down into what I call the positive area. And here is a historical chart where we got well above 75 and now we're starting to come back down. We look at the active asset managers. They had become quite optimistic, getting up to this 90 level. We're falling back a little bit, but we saw a bit of a tick up in this past week. Usually when it's above 90 or so, that's when we start to look at an extreme positive reading. Looking at the active asset managers on this other chart, it's looking a little more extreme. Usually on this chart, I start to notice this when it gets above 80. Or on the previous chart, it's when we get up to about 90. But think about this. These are active asset managers. They kind of got caught off guard as the market was starting to go up. They have to base things on performance. They're going to have their clients calling them and say, hey, did you get in on that last swing up that we had? And so they may be having to react more out of emotion rather than making logical decisions based on what the market is doing. Then we look at the Ridex bear bull ratio. It's coming down quite a bit. As we saw some more upward movement, we're seeing a lot of fear dropping off of this indicator. Looking at the American Association of Individual Investors, we had got above this 20 area. Really only pay attention to this when we get above 30, and we really pay attention when it gets above 40. Well, we saw this drop back down to about 15. It's above 0, so it's positive, but it is dropping a little bit lower. Looking at the VIX, and I thought I was on to something earlier in the week, because on Tuesday, one of the futures contracts that's based on the VIX expired and they were rolling into the next month. And I thought, oh great, this is going to produce some kind of volatility in the VIX. Didn't even have much of an influence at all. We're seeing fear really dropping off on the line chart as well as on the bar chart. And our Ulcer Index, which also measures fear, is continuing to be quite low. This is still positive overall. We're taking the 1 to 3 month T-bills, which mainly is cash, and comparing it to the tech sector. Now, this goes counterintuitive. When this black line is going down, that's good for tech. In 2022, the black line was going up. That's bad for tech, and now we continue to see it rolling over. Looking at the economy, the first thing that we look at is what do they think GDP is going to do? This green jagged line up here is the GDP Now estimate, which is just right now a little bit under 2% for GDP. When you look at the forecast, the top and the bottom, it's around 2% on the top to about 0.5% down on the bottom. Here's what it looks like on a bar chart, where what we're focusing on now is the second quarter of 2023, and it remains positive. Then we look at the spread between risky bonds and not as risky bonds. If things were really running into trouble, this line would be going up, and it's ticked up just a little bit, but it's still going down overall. There's not a real strong correlation between what's happening in the S&P and this index right now, so it really hasn't been telling us all that much. Then every week we look at the financial conditions index. As long as we're below this black line, that means that things are still doing okay. It's when we go above the black line when we get quite nervous. And then we look at the tightening standards, and unfortunately since May 8th, this chart has not been updated. It just shows that banks are getting a lot more stingy with who they're loaning money to. Then we look at the real-time SOM recession rule, also not updated since June 2nd. We're down at the black line. When we really get excited is when it goes above the red line. And it's too bad because these indicators could really help us, but there's such a lag time in when these charts are updated, we might miss out on what's actually happening. And then we look at the smooth recession probabilities. Also hasn't been updated now for a number of weeks. It has not been going up. We get excited when it goes above the red line. Then we look at the Brave Butters Kelly leading index. This is updated more regularly, but still it wasn't updated for the last couple of weeks. This is a little bit of a concern as we're seeing this blue line going above the black line. In inflation, and we will be getting a PCE report on Friday of the upcoming week. We're pretty much flattening out when it comes to CPI inflation and PCE inflation. Keeping an eye on the Fed, they don't meet again until the end of July, but as of the close on Friday, there's a 71.9% chance that they're going to bump interest rates up 25 basis points at the next meeting. Now, this could change a whole lot between now and then to get a little bit of a comparison, where we're actually starting to see the possibility of a 50 basis point hike. Not very strong right now, but that's starting to come into the picture. We look at the Fed balance sheet where it is continuing to decline, and then the assets continue to drop off of the Fed balance sheet. Looking at our breadth, we're still positive here based on price and volume. Even though we tick down, we're above the moving average. When we look at the new highs, new lows, this was really encouraging on the daily charts. We're not really seeing it as much on this chart, where the new highs were really breaking out, and we're seeing a little bit of follow through on this chart, but we're pretty much flat looking at our 10-period moving average. Accumulation distribution, even though it declined, is still above an advancing moving average. The advanced decline ratio, even though both of these lines did decline, they're still above 0. Looking at our trend, we're going up now. We're above the moving average with our ADX. We're still below 20. If you want to use that as some kind of a gauge, the green line is on top, but it is declining since we had a down week. Our Arun indicator is giving us an extreme positive reading and ticked down ever so slightly. The green line on top, that measures buyers. The red line on bottom, that's sellers. When the green line's on top, that means buyers are in control and sellers are not having as much influence. The mass index is not generating a signal right now. And then looking at a daily chart, now I went into this chart and extended this trend line. If you know me very well, you know that I don't like people that put a lot of lines on charts, especially when they make up these phantom forecasts where they have an up and then a down and then an up and then crash all the way down. I think that's total gobbledygook. Well, because we have a trend line that we've been following here, I extended it out just to suggest that maybe this is some of the overhead resistance, even though we didn't get quite to that level. Because if you draw enough lines on this chart, you can make it say pretty much anything you want it to say. Then our trend channel, we're still above the midpoint when we go back to 2009. We're above the monthly pivot on this chart. The 50-period simple moving average, which measures 50 weeks, is still positive. Our long-term trend continues to be positive. McClellan oscillator, seeing some weakness here. We dropped below 0. And then when we look at the summation index based on price, it's turning over slightly. That's a little hard to see, but we've already started to decline based on volume, and sometimes volume can be a leading indicator. The Swenlin trading oscillator, we dropped below 0 based on price and volume. That's switching a little more negative. The PMO and all of our oscillators continued to trend higher on the weekly charts. We were above 0 based on price and volume. And our PMO study, after giving us an extreme positive reading with the PMOs that are rising, that's starting to fall. We're also seeing the same reading pretty much on the daily chart. After getting extreme positive with the buy signals, we're dropping down. We were pretty much flat with the PMOs that are above 0. Looking at the Bollinger Bands on top, where we got outside of it for a little while, well, now we've been able to drop back down, so it's no longer extreme positive. The BPI, almost seeing this exact same thing on the daily chart. We're above 50, but we did decline recently. Here's our oscillators going up with our shorter term oscillators as well as our intermediate term oscillators and our longer term oscillators. Now on the daily chart, we're seeing some of our short term oscillators begin to roll over. We're also seeing the MACD almost ready to give a cross negative and the PMOs turning down. The only ones that are still hanging in there are the longer term oscillators because they take longer to move. The Chaikin money flow, even though it declined slightly, is still positive. The Chaikin oscillator, after giving us an extreme positive reading, is dropping back down. The force index dropped a little bit, but is still positive. Money flow above 50 and declining, so that's still positive. The rate of change going back 1 week, it declined because we were down on the week. Going back 50 periods after getting to kind of an extreme positive reading is dropping back slightly. The RSI going back 14 weeks, we were showing a lot more improvement, but we did drop back. However, we're still above 50. And this is also another contradiction that we're seeing. On the daily chart, the special K is crossing over positive. Here on the weekly chart, we're crossing over negative. Not quite sure what to make of that, although we tend to follow the daily charts more. We want to be aware of this negative trend in the overall background. The Stochh RSI, after being extreme positive, has dropped back down. The Williams percent R is still extreme positive, even though it's dropping. The Kopit curve continues to generate a buy signal. Ultimate oscillator is still extreme positive, even though it's rolling over. The vortex is still extreme positive with the green line headed up. Looking at our longer term trend, not really coming down to any of these levels unless we really run into trouble. Our different charts, we're still looking okay on the Heikin Ashi, where we're turning a little bit more negative on the daily charts. The KG still has a black line that's pointing up, where we have a black line that's pointing down on the daily charts. The Renko is still looking positive, and the 3-line break is also looking positive, the same as the daily charts. The ease of movement with the down week, we did see a bit of a decline here. Over the last 14 weeks, we are seeing some improvement. That's the indicator on the bottom. On top, we have an equivolume chart, where when it's green, that means we're up. When it's red, that means we're down. Pretty easy to understand. The thicker these bars are, the more volume there is. So they're trying to take a lot of things and put it all into one chart. We did not see anything new generated on the point and figure chart. It's still looking positive overall. We have an ascending triple top breakout that was generated on May 15th. We also have a double top breakout on May 18th that was generated on the daily chart. Our different trading systems, we switch back to neutral for the Elder Impulse system. The dots are still underneath on the parabolic SCR. One warning sign. On the daily chart, the dots have now gone on top, and that's negative. Looking at the broad market, here's the S&P, the mid caps, which haven't been really performing as well, and the small caps. The Dow continues to be in an overall uptrend. The NASDAQ is still in an uptrend. NASDAQ 100 in an uptrend. Mid caps seeing more of a downtrend, even though they tried to bounce back up. We're starting to cross just a little bit back positive. It's kind of hard to see. The blue line is just barely above the red line. The small caps are still in an overall downtrend and saw weakness this past week. NYSE continues to be in an uptrend. The Wilshire is also in an uptrend. All stocks, even though they declined, are still in an uptrend. 30 biggest software companies are also in an uptrend. FANG continues to be in an uptrend and is coming back and possibly testing its all-time high. ARK is still trying to give us a golden cross here. We do have a golden cross on the daily chart, but as with a lot of other things this past week, it saw some weakness. It was down 4.9% for the week. Looking at the banks, where we were showing some improvement with the KBW Bank Index, it had been giving us an extreme negative reading with the RSI and is starting to go back up. Well, now it's coming back down. The MACD is starting to cross over positive after being pretty extremely oversold. The bank deposits, we're seeing a little bit of a tick up overall. And then looking at traditional Dow theory, we're seeing a little bit of improvement with the transports, but over the last couple of days, they were showing some weakness, and the utilities are showing some more weakness on a shorter term basis. Some broad market measures. The CRB index continues to be in a downtrend. Oil is also in a downtrend, actually broke below 70. Copper is in an overall uptrend on the weekly chart, but it's really starting to fall back. So far, the 200-day moving average has been helping out. The dollar was up just slightly over the past week. Gold continues to be in an uptrend, but recent weakness, as silver is also in an uptrend, but recent weakness. Looking at the total bond ETF, we are still in an uptrend, but we've been chopping sideways. Looking at yields, this is a daily chart where we've been pretty much chopping sideways with the 2-year yield starting to go back up, where was a bit of a decline in Friday's session. The stock to bond ratio shows that stocks continue to outperform bonds. Then a weekly chart looking internationally with the US, UK, and German rates. The UK has now assumed the lead because they really bumped up their rates. Japan is its own little story that we're keeping an eye on. Then looking at the MOVE index, this is a daily chart showing the volatility in bonds where it's decreasing. The VIX measures volatility in stocks. That's decreasing, even though it ticked up a little bit on Friday. The green line is the spread between the VIX and the MOVE index, and here we have the S&P in red. The correlation is not as strong as it has been, but it is starting to show some improvement. Then this is pretty much back to normal now. We look at the 1-month yield and subtract the 3-month yield, and we should get a negative answer below 0, and that's what we're getting now. Looking at some relative studies, here's a longer-term look at the intermarket analysis chart, where if you go back to the beginning of 2022, oil is still in the lead, followed by the dollar, and then gold, where stocks and bonds are still negative. But when you go back to the beginning of 2023, stocks are doing the best. Gold and bonds are about tied for second place, with the dollar still hanging in there, where oil is the one that's really showing some weakness. The NASDAQ is really outperforming the S&P. The S&P 100, the bigger stocks, are outperforming the rest of the stocks in the S&P 500. Growth is showing improvement when compared to value, and we're seeing a golden cross in this ratio. Gold is still in an overall uptrend, but it's been going down compared to the S&P. Bonds continue to underperform stocks. Looking at gold to the dollar, we came right up to this red trend line and we've been bouncing back down. Then we look at the low volatility stocks compared to the S&P. They are really underperforming, where they held up a lot better in 2022. Energy is really starting to underperform tech, and discretionary is starting to really outperform staples. Looking at our longer term charts, these are the positive seasonality and setups that I talk about that apply to the much longer term. The NYSE breadth thrust was generated back in October. That's looking a lot better. And then back in March, we had the ZWEG NYSE breadth thrust generate a signal. And these are more or less indefinitely on the books unless the pain just gets too severe that we can't heed them any longer. The NYSE Zahorchak, good old Midwestern name there, still remains on a buy signal. Looking at our momentum studies, we're still keeping an eye on this breakout of these trends where it failed back from 1998 to 2004. It also failed from 2007 to 2010. However, right now, when we broke above the trend line, the MACD was about at zero and continues to advance. That gives a lot more strength to this breakout above the trend line. So here's the economic calendar for the upcoming week. We will get GDP on Thursday, but that's the third estimate, so it's almost a little like old news unless it comes in drastically different. Probably the most important day will be on Friday. That's another inflation gauge. Here are the speeches coming up. Jerome Powell's going to Portugal, and then he's going to Spain. It'll be on Wednesday and Thursday of this upcoming week. The Stock Traders Almanac statistics for June 26, which will be Monday, were negative across the board historically. Then looking at the performance, we're coming into that weaker time in June. On Monday, we will be on the 17th trading day of the month, where we see weakness overall. Whether it's a regular year or a pre-election year, we have a couple more days of that where historically we see some strength going into the end of June. Then here's an updated chart showing how the NASDAQ has its best 8 months going into the middle part of July, and this is about where we're at currently. So our scenarios, can't really go with the down one right now. On our daily charts, we are positive, but we are starting to turn more negative. We can't really go with the up one, and we can't really go with the sideways one for right now because the ADX is showing that we are in a trend. Our warning signs, the parabolic SAR on the daily charts is negative. The BPIs continue to diverge, but the S&P 500 BPI continues to hold up, at least for now. The VIX is showing complacency. The Kopit curve buy signal has now gone away on the daily chart. The cumulative new highs and new lows for the NASDAQ are showing weakness. We're above the 2007 levels with the 3-month yield. That's right before we had the great financial crisis. Is that a warning sign? Earnings season is still kind of trickling along. Looking at the positive signs, this is the seasonality and setups that I just talked about a minute ago. The long-term special K indicator on the daily chart has turned positive. It's turning negative on the weekly chart. Then I'm looking at the longer-term moving average, 253 periods of the equity put-call ratio. It is starting to turn more positive, and I go over that each day in the daily videos. The Pring bottom fisher is still generating a buy signal. The S&P is still above a downtrend channel upper line. I haven't been showing that, but if we start to fall back on a daily basis, I will be bringing that chart back up. We're still in a risk-on posture, so that favors stocks. Lower price levels, fib levels, moving averages, other indexes, they may provide some kind of support if we fall. The S&P continues to outperform utilities, which could be good for the market. The NASDAQ and NASDAQ 100, even though they were down, continue to break out, but we have some pretty significant overhead resistance at where we're at right now. The staples to S&P 500 ratio, even though it ticked up on Thursday and Friday, continues to underperform overall. That could be very positive for the S&P 500. The mid-caps generated a recent golden cross on the daily chart, and small and especially mid-cap growth continues to be in an uptrend overall. So thank you. I hope you found this helpful. Please feel free to check out the daily video. I hope you have a wonderful weekend, and I will talk to you in the next video.